When the markets see hotter than expected inflation, what the traders believe is, oh, the Fed's going to have to fight harder to win the inflation war. And that means higher for longer, not as many cuts, a tighter Fed. That's good for the dollar. That's bad for gold. They're wrong. What higher than expected inflation means is that the Fed already lost the war on inflation. It's not going to fight harder. In fact, it's going to surrender. Inflation won. It just hasn't admitted that yet. It's still pretending. The Fed is still pretending that it won. It didn't even come close to winning. It's already surrendered. The markets just haven't figured that out yet. But at some point, they're going to realize that that white flag has been waving, and that is bullish for gold. Higher inflation is always bullish for gold, especially when the Fed can't do anything about it.
Gold futures have experienced a remarkable week of gains, climbing nearly $100 per troy ounce over 3 consecutive trading sessions. This surge in price comes in the wake of the latest Consumer Price Index (CPI) report, which reveals persistent inflationary pressures that have captured the attention of both financial markets and Federal Reserve officials. The November inflation report indicates a 2.7% annual increase, a slight uptick from previous months, while core inflation, which excludes volatile food and energy prices, has risen by 3.3%. While these figures align with economists' expectations, they signal concerning inflationary trends that may continue to affect the broader economy. Federal Reserve Chairman Jerome Powell has acknowledged the progress made since inflation peaked at over 8.5% in March 2022, but remains cautious about the current economic landscape. At a recent conference, Powell noted that economic growth is stronger than anticipated, yet inflation continues to present challenges. Given the latest economic data, the Fed's ultimate goal of achieving a 2% inflation target still appears distant. The continued rise in inflation suggests that the central bank may face increasing difficulties in controlling price pressures in the near term. According to Peter Schiff, the recent fluctuations in gold prices, particularly in response to inflationary pressures, highlight the metal's unique role in the current economic landscape. Despite a strong US dollar, gold's price recently dropped by nearly $50 per ounce, falling from around $2,700 to $2,650. This shift followed a brief rally that saw gold approaching new highs before inflation data pressured the market. Schiff argues that higher-than-expected inflation does not necessarily lead to a stronger dollar. Instead, it signals that inflation has outpaced the Federal Reserve's ability to control it. As a result, Schiff believes gold is poised for long-term gains, as rising inflation could diminish the Fed's ability to manage price pressures, increasing gold's appeal as a hedge against economic instability. As we bring you clips from the discussion, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this.
You got a big drop in gold the last few days. Gold's about $50 an ounce lower than it was when I did the podcast on Wednesday. It was at 2,700, basically just below. In fact, it went to 27.17 or so after that. It had a little rally. It almost got, almost got close to new highs. And then these bad inflation numbers clobbered it. And now gold is back to 26.50. But inflation is good for gold. I've been talking about this paradox for years now because the markets don't get it. When the markets see hotter than expected inflation, what the traders believe is, oh, the Fed's going to have to fight harder to win the inflation war. And that means higher for longer, not as many cuts, a tighter Fed. That's good for the dollar. That's bad for gold. They're wrong. What higher than expected inflation means is that the Fed already lost the war on inflation. It's not going to fight harder. In fact, it's going to surrender. Inflation won. It just hasn't admitted that yet. It's still pretending. The Fed is still pretending that it won. It didn't even come close to winning. It's already surrendered. The markets just haven't figured that out yet. But at some point, they're going to realize that that white flag has been waving, and that is bullish for gold. Higher inflation is always bullish for gold, especially when the Fed can't do anything about it. Their hands are tied behind their backs. In fact, before too long, probably during the Trump administration, the Fed is going to have to fess up and say that it's willing to accept higher inflation, that that's just the price we have to pay to stimulate the economy, to deal with the debt, to whatever. It's going to come up with an excuse. I don't know if it's going to raise its official target to 3 or whatever it's going to do, but it is going to be cutting rates. It is going to be doing quantitative easing even as the inflation numbers move further and further north of 2%. And in fact, we got numbers on Thursday for jobless claims that unexpectedly shot up from 225,000 last month to 242,000. Last week to 242,000 and in the last week. And the 4-week moving average jumped up from 218.50 to 224 and a quarter. This is the highest number of claims we've had in a while. And again, could be the beginning of a big trend on increasing unemployment. The economy is weak. Again, the weak economy is the reason that Trump was elected. And that weak economy that got Trump into office is going to continue while he is in office. And the tax cuts may stimulate consumption, but they're not really going to stimulate the underlying economy. Meanwhile, Wall Street is celebrating. Donald Trump went down and rang the opening bell with his beautiful wife, Melania, who, she's 54. She looks fantastic. So, that sends a good signal, I guess, to everybody that there's a lot of beauty after 50 in modern women. But he was there with her. I think R.F. Kennedy Jr. was there with him. I forget the rest of the entourage that came down to the New York Stock Exchange, but they're all excited because, he's so pro-business. Well, he was pro-business when he was president the last time. That was the whole reason that everybody elected him. He was a businessman. He wasn't a politician. So is he more pro-business now than he was when he was elected the first time? No. I mean, maybe some of his cabinet people are a little less the establishment. They're very successful business people on their own right. But this is not a 180-degree change. Yes, we're going to have fewer regulations. Maybe we'll repeal a lot of the regulations that were put in place by Biden. But even if we go back to the regulations we had under Trump, we still had a lot of regulations under Donald Trump. The bigger issue, the ticking time bomb, is not going to get diffused. This deficit is exploding out of control, and the economy is on the verge of a severe recession, in part caused by the backup in interest rates. And interest rates are rising. I mean, even though the NASDAQ hit another new record high today, the Dow was down for the second consecutive week. The markets maybe are starting to take notice of rising bond yields again, rising mortgage rates again. And the economy, the data is not good. I don't know what people are looking at to keep talking about the fact that we have strong data. In fact, the Fed must even know this. That's why they're cutting, right? They know that the economy is weak. They just want to continue to pretend that it's strong. Janet Yellen said in response to a question about the debt, she was asked, are you worried about the national debt and the size of the debt? And she said, no, I'm not worried at all, because the key is the financing costs, and interest rates are really low. And so it doesn't cost us a lot to finance the debt. And I said at the time, yes, but interest rates aren't going to stay low. In fact, the Federal Reserve just told you they're going to start hiking to fight all this inflation that you helped create. So she specifically said the debt isn't a problem because rates are low. And now she's apologizing for not doing more about the deficit, especially since rates have gone up. Well, duh, we knew they were going to go up. She knew they were going to go up. I don't even think, sorry doesn't cut it. I mean, when you do this intentionally, she owes a lot more than that half-assed apology for the part that she played in this disaster.
The growing concern over soaring government debt destabilizing financial markets has been highlighted by the Bank for International Settlements, BIS, in its latest quarterly report. The BIS urged policymakers to take swift action to prevent economic damage, warning that markets are starting to recognize the increasing burden of government debt. While the threat of bond vigilante attacks, where investors push up borrowing costs to curb fiscal irresponsibility, has not yet materialized, the BIS cautioned that waiting for this to happen could be too late. The rising volume of government debt is becoming a pressing issue that needs immediate attention. In the U.S., the fiscal deficit is already alarming, with the first 2 months of fiscal year 2024 recording a massive $624 billion deficit, a 65% increase from last year. This could result in a $3.65 trillion deficit by the end of the fiscal year, surpassing the previous record of $3.1 trillion set in 2020. Despite claims of a strong economy, These record deficits suggest that fiscal stimulus is vital to sustaining growth. This contradicts conventional economic theory that a strong economy should naturally generate surpluses. This disconnect raises concerns about the true state of the U.S. economy, as rising frustration among citizens, particularly regarding financial struggles, is driving political shifts, with support growing for figures like Donald Trump over President Biden. If these deficits continue to grow, inflationary pressures will likely rise, as economist Peter Schiff warns, potentially devaluing the dollar and leading to broader economic instability.
First two fiscal months of 2025, because we're already in that fiscal year. We're not on a calendar year. We're in fiscal 2025 for the U.S. government. And for the first 2 months, the budget deficit in those 2 months alone was $624 billion. That's a 65% increase over the same 2 months a year ago. The first time that the United States government ran a $624 billion deficit for an entire year, not just for 2 months, but for an entire year, was 2009, right? That was immediately after the 2008 financial crisis. And so we had a huge Great Recession, we had stimulus, and we had a deficit that was higher than that. But now, of course, annual deficits are much higher. If you extrapolate the first 2 months of 2025, if you assume that the rest of the months are also 65% greater than the prior months, we're going to be looking at $3.65 trillion deficit for fiscal 2025. Now, of course, that assumes we don't get any tax cuts under Trump, which is a pretty bad assumption. So we're actually going to have a bigger deficit. My guess would be that the fiscal deficit for that year will be over $4 trillion. But if we just stay on the current path and Trump doesn't make it any worse, which is, an outside chance, but assuming Trump doesn't make it any worse, it's going to be the biggest deficit in 1 year we've ever had. In fact, the record right now is fiscal 2020. That's the COVID year, right? Or the deficit was 3.1 trillion during that year. Or that was, a good portion of the economy was shut down due to COVID, and we had all the stimulus flooding in. The debt is bigger now. And so what does that mean? That means that the U.S. economy is currently getting a bigger fiscal stimulus than it did when the economy was shut down due to COVID. Now, first of all, if the economy was really as strong as everybody claims, why does it need a record amount of fiscal stimulus? In fact, when you have a strong economy, that's when the government is supposed to run a surplus, because the economy is so strong and it's supposed to pay down the deficits that it ran up when the economy was weak. But here, everybody is talking about how great the economy is. In fact, again, I was watching on CNBC today, and this woman was on there from one of the brokerage firms talking about how strong the economy is, saying it's great. The consumer's in great shape. Everything is fantastic. They're really strong. We've never seen the consumers in such good shape. And I mean, does this woman not realize that the consumers just voted out the Kamala or Biden, and they voted for Trump because they wanted change, because their financial circumstances are so dire? I mean, if consumers were in the greatest shape ever, according to this Wall Street analyst, they would have voted for Kamala, tried to get rid of her because things are so awful, and they were hoping that Trump would change things. Why would you want to upset a great situation, right? So again, these guys are still clueless about what's going on Main Street, right? If you're on Wall Street, you have no idea what it's like to live on Main Street. But anyway, so we've got this record amount of fiscal stimulus. Again, it's like, you're lying in a hospital dead, and you're plugged in to all kind of artificial life supports. You got tubes coming out your mouth, tubes coming out your nose. You got blood coming intravenously into your body, right? You're in this bed, and you ask the doctor, well, what's going on? He goes, oh, you're in great shape. You're perfectly healthy. Except if we unplug any of these things, you're going to drop dead, right? So obviously, I mean, the country is in horrible shape. Where would it be without all this stimulus? Now, yes, we haven't been getting as much monetary stimulus yet. That's coming. But we have a record amount of fiscal stimulus. That's why all these jobs, like pretty much all the jobs created under Biden, are government jobs created with deficit spending. So this is a disaster. The better of the numbers as far as expectations, right? It wasn't really worse than expected. It was as expected, which was bad, right? So the consensus was for an increase of 0.3 in November, and we rose by 0.3. And that was higher than the 0.2 from October. Year over year, CPI was up 2.7, higher than the 2.6 year over year the prior month. So we're going in the wrong direction. Core, ex food and energy, up 0.3 on the month. Again, another 0.3. We've been there for like the last 4 or 5 months in a row, I think. And the year over year core was also up 3.3. We've been stuck at around 3.2, 3.3 for month after month after month. Nowhere near 2%. How Powell can look at these numbers and conclude that we're on a glide path of 2%, it's beyond me. You can't. All these numbers confirm is that inflation is bottoming out and is headed much higher. And it never got anywhere near 2%, especially if you look at the PPI, Producer Price Index, which is a leading indicator for the CPI, because generally the businesses have their prices go up first, and then they pass it on to the consumer second. So the PPI is more forward-looking than the CPI. And there, the numbers were really bad. So the expectation for the increase in November producer prices was 0.3, and we got an increase of 0.4, and that was double the increase from the prior month of 0.2. So we're really heading in the wrong direction fast. On the year over year, producer prices was supposed to be 2.6. It's 3%. We got a 3 handle now, not a 2 handle. Last month, the year over year PPI was 2.2%. Now it's 3. Now, I've been saying this on my podcast that the year over year numbers are going to start to get a lot worse due to the comparisons. And that's what's happening. So now we have a 3 handle. How long before we have a 4 handle? Not long. Look at the ex food and energy. There, it was a little bit better, actually, because it was only up 0.2, which was the consensus, right? So, and that was a little bit less than the 0.3. But the year over year core was supposed to be up 3.2. It was up 3.4. That was much higher than the 3.1 year over year from the month before. So the Fed wants 2% core. We're at 3.4 and headed in the wrong direction. Yet the Fed is going to cut rates by another 25 basis points. By the way, the ECB cut rates 25 basis points this week, and the Swiss National Bank went for the supersize 50 basis point cut. They cut in half. I think they went from 1% to 0.5%, right? Inflation is going to rear its head in a big way all over the world. The Eurozone, Japan, all these countries that are cutting rates should not be cutting rates. Inflation is going to roar back stronger than ever, right? Worse than what we had in 2001, 2002. That's what's coming. Ex food and energy year over year was 3.5. So these are strong numbers. Now, on top of that, adding insult to injury were the import-export prices that came out this morning. They were looking for a drop of 0.3 in import prices. Instead, we got a rise of 0.1. And year over year, they were looking for an increase of 1. We got an increase of 1.3. On the export prices, they were looking for a drop of 0.1, and we were unchanged. And the year over year export prices are up 0.8. The month before, they were down 0.1. So again, we are moving sharply in the wrong direction. Inflation is getting worse as the Fed is pouring gasoline on the fire.
Despite expectations that global interest rates will continue to decline in 2025, providing a supportive environment for gold, the outlook for the metal heading into the new year remains uncertain, according to the latest report from the World Gold Council, WGC. Gold prices have surged to $2,700 an ounce, positioning the metal to end the year with a nearly 30% gain, marking its strongest rally in decades. Investor sentiment surrounding gold has shifted since last year, with initial optimism heading into 2024, driven by market expectations of aggressive rate cuts by the Federal Reserve. Despite the Fed's persistent hawkish stance throughout the year, gold prices reached consecutive record highs, largely fueled by strong central bank demand. Looking ahead, analysts at the WGC predict a more nuanced gold market as investors assess the global economic landscape. Central banks' robust purchasing has supported prices, but this trend may not continue at the same pace in 2025. As the Federal Reserve begins its easing cycle, investor sentiment will likely continue to evolve, with gold's role as a safe haven asset remaining critical amid ongoing global economic uncertainties. Please share your thoughts on Peter's analysis in the comments below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.